Hi everybody, Quinn Waddington here, Senior Investment Advisor and Branch Manager at Canaccord Genuity Wealth Management. Here with you just to share something I've noticed. Obviously summer's coming to an end here, school's about to start, and probably more people than we've seen in the last 3 years are about to head back to physical office work. But it is slow right now in the last couple weeks of summer, and that always gives me time to look back and think about plans going forward. And one thing I've noticed, even looking back over the last 3 years, we obviously had the markets crash in 2020, the beginning of the COVID pandemic, and then the first 6 months of this year, very negative markets as well. In 2020 and through 2021, very strong markets that bounced right back from that 2020 dip. Right now in July and most of August, we've had strong markets recovering about half of what was lost in the first 6 months of 2022. Still nowhere near highs, but it has brought up the one way that I've realized over the 6, 7, 8 corrections that I've been through, the one almost guaranteed way that you can benefit in the markets, and that is to have a financial plan, which is part one, and then part two is to actually follow through with that financial plan. So in the positive scenarios of the markets, the hyped euphoria of things like cryptocurrency, the meme stocks, cannabis a couple years ago, people jumping on those trends. Obviously there's some exceptions with people getting lucky in market timing, picking the right stocks, but overall those jumping on those trends tend to be at the end of those trends and usually get burned when the trend goes the other way and it goes dramatically down. So we've seen that in all of those scenarios I mentioned. On the other side, when markets drop dramatically, like we saw in 2020, and of course over the first 6 months, especially in June this year, the media is very heavy on how negative it is going into a recession, rates going skyrocketing, very negative news. Of course, the beginning of the pandemic, very negative news and death counts and how the COVID was sweeping across the world. Markets are forward-looking, look through a lot of that, and will turn on a dime sometimes seemingly without reason. So sticking to that plan, having that plan in the first place and sticking to that plan avoids the emotional decisions that come from investing, and those are natural emotions that come. The FOMO on the way up of you're hearing stories on Reddit or from neighbors or social media, whatever it is, of people making a bunch of money on things that don't really make sense for the most part, and things that you don't understand. And then on the way down, of course, the negative news in the media scaring people that the markets will just continue down forever, which of course isn't true either. Sticking to that plan, continuing with those regular monthly contributions, even if it seems like your accounts are going down. When the markets are dropping, you're buying at lower and lower valuations. The one thing true about the markets is that they are impossible to predict in the short term. But luckily for us and for those with time horizons over a few years, the longer and longer the time horizon you have, the easier the markets are to predict, because of course they go up in the long run. So that's one true scenario there that you can kind of bank on. So sticking to your plan, and that brings me to, how do you do that? Of course, working with a professional to get a plan in place, something organizing your incomes and your expenses and figuring out what your objectives are to get you into and through retirement and any, shorter term objectives along the way. Figuring all that out, and then continuing to work with that professional to make sure you stick with that plan, which is, there's really no point in getting a plan put in place if you're just going to take that plan and stick it in your drawer and forget all about it. So working with somebody to get you through those emotional times, those decisions where you want to throw a bunch of money at something, some hot tip that you got or some hunch that you have that may not have been completely thought out, again, making an emotional decision, or in those times like we've seen in the first 6 months or back in early 2020 when the markets are falling and you want to, your emotions are guiding you to just get out and sit safely on the sidelines. Of course, if you had done that in 2020, you would have missed massive gains coming out the other side of that. And the same will likely be true. The markets will be volatile here as we continue to struggle with the recession and the interest rate. But whether they head straight back up from here or have another dip before we head back up, nobody knows. But again, the longer your time horizon, so if we're looking out a few years from now, you'd probably be happy that you stuck with that plan and continued forward. So bit of a long rant there, but my one big tip that I keep coming back to and seeing it time and time again has nothing to do with picking a stock, has nothing to do with figuring out market timing. Get a financial plan in place and stick with that plan. And if you're not able or willing to get the plan and stick with it, know your limitations and work with a professional that can help you do it. That's where all the value is, getting those plans in place. Of course, there's investment management, tax planning, estate planning that come along with it, but the value of having somebody work with you to guide you through those emotional decisions and eliminate those as much as possible is where the real value is. So if you have any questions, you want to reach out and just chat, give me a call, send me an email. Happy to discuss. Until next time, take care, everybody.